All right. Good morning, ladies and gentlemen. Welcome back to Financial Accounting. You guys could all come in, take your seats, get settled. There is a warm up on the board. I'll give you guys a few minutes to do that, and then we'll get started with today's lesson. All right. So make sure you guys have that filled out. Today's warm up was classifying the following accounts. Main purpose of this is to make sure you guys remember this from chapter 1, basically, because we are moving forward today. Okay, so for today, we are moving on to chapter 2 in our book. So we have our online textbook here. As you guys can see, chapter 2 is all about analyzing transactions into debit and credit parts. This particular lesson, lesson 2-1, is about using T accounts. A couple learning objectives, a couple keys for today. One is to show the relationship between the accounting equation and the T account. 2 is identify the debit and credit side, the increase and decrease side, and the balance side of various accounts. And finally, learning objective 3 is to restate and apply the 2 rules that are associated with the increase side of an account. Okay, so far in this class, in chapter 1, we were understanding transactions, accounting transactions in terms of this accounting equation. So for those of you, as a reminder, this here is the accounting equation. Assets equals liabilities and owner's equity, with assets on the left side, liabilities and owner's equity on the right side. The big thing here, as you guys remember, is these have to balance. And all of last week in chapter 1, this is how we were breaking down transactions. However, in the sense of a full-scale business, when you start getting a bunch of transactions, more and more accounts, this becomes really, really impractical. So today we're going to start looking at different ways to better analyze transactions. One way to do that is at the account level using T accounts. So within each of these, the assets, liabilities, and owner's equity, as we learned in chapter 1, there are a bunch of different accounts. So again, that was today's warm-up. So cash is an asset, accounts payable, liability, owner's capital is an owner's equity. So within each of these 3 classifications, so these are the classifications, within the classifications, there are a bunch of accounts. So starting today, we're going to start analyzing transactions at the account level using a T account. This is a T account right here. It's called a T account because it looks like a T, plain and simple. Each different account will have a T account, so there will be a cash T account, an accounts payable T account, owner's equity T account, so on and so forth. Within those T accounts, there is simply a left side and the right side, a debit side and a credit side. There's really no rhyme or reason as to which one's which. You just have to remember the debit side is the left of the T account, the credit side is the right of the T account. Again, there's really no crazy reason behind that. It's just left is debit, right's credit. Even down here in the definition, a debit, an amount recorded on the left side, credit, amount recorded on the right side. What these T accounts are used for is just a tool. It's a tool to use to analyze transactions. So in a second, we'll learn what a debit and a credit, or how a debit and a credit affects different accounts. And this T account is just used to track the changes in individual accounts and have a running balance. So this page right here, this picture right here, this is something that you guys want to commit to memory. This is something you guys want to put into your notes. This is the meat of today's lesson. What this is showing is how debits and credits affect different accounts depending on what classification they are, what side of the accounting equation they are. Super important right here. In fact, I'll give you guys a second. If you guys want to take a picture, put this into your notes, commit this to memory, whatever it may be. Again, super important right here. Okay, so again, should be familiar from chapter 1. We have the accounting equation up top. So assets on the left side, liabilities and owner's equity on the right. And this equals, again, shows that they all balance. But remember, balance is important. So over here on the right, any asset account. So again, going back to the warm-up, we had cash is an asset, accounts receivable is an asset, supplies are an asset. Any asset is going to be affected this way by debits and credits. So in chapter 1, how we were saying plus and minus, now we're going to say debit and credit. On an asset, a debit represents an increase to that account. So if we have a debit to the cash account, that will be an increase to the cash account. On the other side, a credit represents a decrease to an asset. So if we spend cash, if we send out cash, we have a decrease in cash. That is going to be a credit to the cash account. And then using this T account, you can keep the debits and credits together so that you can track the activity within that account and have an overall balance going with that account. So that's on the left side. This is any asset: debit increase, credit decrease. Now, also within a T account is what's known as a normal balance. The normal balance is simply whatever side of the T account represents an increase. So in this case, debit represents an increase. So in assets, debit is the normal balance. On the other side of the equation, so now we're on the right side of the equation, it's going to be the opposite. So liability and owner's equity, since they're both on the left side, or sorry, the right side of the accounting equation, they are both going to have the same effect with debit and credits. Starting with liabilities, so again, we're looking at mainly accounts payable is the main liability we're going to see in the book so far. It's the flip of the asset. So now we are going to have a credit representing an increase. So if we owe someone more money, liabilities again are claims against the company, so owing money to other people. If we have an increase in money that we owe, so an increase in accounts payable, that's going to be represented by a credit. So now a credit represents an increase. And the opposite, debit represents a decrease. So if we pay off some of our debt, now we owe less money to someone. That's a decrease in a liability, and that's represented by a debit. Again, normal balance for a liability is a credit, just because credit increases. Again, normal balance is just the side that represents an increase. So with a liability, it's a credit. Owner's equity, same thing. Being that it is on the right side, the same side of the accounting equation, it's going to be the same thing. So credit increase, debit decrease with a credit normal balance. Any questions on that? Everyone follow me so far? Okay, good. Because again, this is the meat and bones of this lesson. If there's anything you guys take away from this lesson today, it's this picture right here. All right. And that's about it for the day. Again, we looked at the relationship between the accounting equation and the T account. We identify the debit and credit side, the increase and decrease side, and the balance side of various accounts, and restate and apply the two rules that are associated with the increase side of an account. Now, to reinforce that, what I want you guys to do is in your end of lesson review on our online textbook, open up the working papers. Now, within these working papers, we have two sections. Excuse me. We have two sections. We have the work together and the on your own. Today here in class, we are going to start with the work together. I'll give you guys a few minutes to do this on your own. I'll allow you guys to partner up, work in small groups, work through this on your own, and then we'll go through it as a class. And then this on your own section will be due tonight for homework. So starting now, I'll give you guys a few minutes to do the work together section. If you guys would like to partner up with the student next to you or create a small group of 2 or 3 or 4 people, I'll give you guys a few. Go ahead and work through that now. Okay, good. Let's start working through that. So what this exercise was asking is giving you a bunch of T accounts for different accounts. So we have the cash T account, we have the accounts receivable, supplies, prepaid insurance, a lot of the accounts that we looked at in the warm-up. So you guys were able to classify them via the warm-up. Now it's just asking you to fill out or describe how the T account would work for those different accounts. So we started with cash. John, can you tell me what's the classification of cash? Is cash an asset, a liability, or an owner's equity account? Right, it's an asset. So from there, how would you fill out the remainder of this T account? Right, as always, debits on the left, credits on the right. So that's going to be the same for all of these accounts. No matter what account it is, no matter what classification, debits on the left, credits on the right. In fact, if you look through, all the different accounts. We have credit, debit on the left, credit on the right. All right, so for an asset, what does a debit do to an asset? Right, it increases, so it represents an increase. If a debit represents an increase, what does a credit represent? Right, credit represents a decrease, the opposite. And then the normal balance. Right, normal balance is just the increase side. If we have debit increase, the normal balance is going to be debit. All right, next up we have an account receivable. Katie, is an account what classification an account receivable? Right, that is also an asset. So because it's the same classification as cash, do we think this T account is going to be any different? No, so it doesn't change based on the account, it changes based on the classification. So because these are both assets, we're going to have the exact same T account. Debit on the left, credit on the right, debit increase, credit decrease with a normal balance of debit. Very well done. So let's try to find another type of account. So we move on to accounts payable. Sarah, what kind of classification is an accounts payable account? Right, this is a liability. So we went over that in our warm-up. On our warm-up, we had accounts payable, and we remembered that that is a liability. So being a different classification, it's going to be different than these assets, right? Right. So it's always debit left, credit right. Now, which represents an increase? Good, it's going to be the opposite. We're on the other side of the accounting equation, so it's going to flip. Now, credit represents an increase, and debit represents a decrease. And since credit represents an increase, we have a credit normal balance. Let's see what else we have. Okay, and the last one here, I'm going to skip over this one because it's another accounts payable. It's the same setup as the first accounts payable we went through. This is just for a different company. So this is what Sawyer Supplies owes us, and this is what we owe Sawyer Supplies and what we owe Oceanside Supplies. So same thing, just different accounts. And then finally, we have Parker Vogel Capital, aka the owner's capital. So Parker Vogel is the owner of the company. This is his capital account. Phil, what type of account is owner's capital? Right, owner's equity. Is it going to be any different than the liability accounts, however? Right, it is not. It is still on the left side, on the right side of the accounting equation. So it's going to have the same setup: debit decrease, credit increase, the credit normal balance. All right, everyone with me on that? Any questions? Again, debit and credit is always going to be left and right. Debit's always on the left, credit's on the right. Now for assets, debit's going to be an increase and credit's going to be a decrease. For liabilities and owner's equity accounts, debit is going to be a decrease and credit's going to be an increase. Normal balance, again, is just the side that represents an increase. Okay, so for homework, first of all, make sure you guys have that saved and submitted. And for homework, you guys are going to be working on the on your own section. Same setup, same type of questions, just with a couple different account titles. Okay? So quick wrap up here, and then I'm gonna let you guys go for the day. Again, main piece of information, I'm even gonna go back to it because it's so important. Main piece of information I want you guys to take away is this picture right here. Anything on the left side of the accounting equation, assets, is going to have a debit increase, credit decrease with a debit normal balance. And anything on the right side, liabilities and owner's equity, it's going to have a debit decrease, a credit increase with a credit normal balance. Okay? Make sure you get that on your own section completed for homework. That'll be due before the start of class tomorrow. As always, if you guys have any comments, questions, or concerns, feel free to reach out to me and ask. If not, you guys are free to go to start your homework. Enjoy your day, and I will talk to you all tomorrow.